The first cryptocurrency-based tax evasion sentence in the U.S. has been handed down, and it highlights a major problem with taxation and fiat currencies. I'll break it down on this episode of The Effect. Hi, I'm Nate Martin, and this is the Bitcoin Effect. An Austin, Texas man, Frank Richard Algren III, has been sentenced to 2 years in prison for filing false tax returns and concealing $3.7 million in Bitcoin gains. According to an announcement by the Department of Justice, Algren acquired 1,366 Bitcoins in 2015 and sold 640 of them in 2017, using the proceeds to buy a Utah home. He misreported his 2017 taxes, inflating the cost basis to reduce taxable gains. And between 2018 and 2019, he used wallets and mixers to hide an additional $650,000 in sales in Bitcoins, which he failed to report. The DOJ stated his actions caused over $1 million in tax losses. Judge Robert Pittman sentenced him to 2 years in prison, a year of supervised release, and more than $1 million in restitution. Officials emphasized cryptocurrency's traceability, warning others against tax evasion. Acting Special Agent in Charge Lucy Tan of IRS Criminal Investigations Houston Field Office said, quote, "This case marks the first criminal tax evasion prosecution centered solely on cryptocurrency. As the prices for cryptocurrency are high, so is the temptation to not pay taxes on its sale. Avoid the temptation and avoid federal prison." Here's my take on this. The capital gains tax on non-consumption commodities like gold, Bitcoin, or other sovereign currencies is theft of your assets because of the government's propensity to debase the currency. Well, let me explain. And we'll use $100,000 Bitcoin just to make the math easy. If you have a Bitcoin and over the period of the year the U.S. government prints more money and debases the currency to the point where it takes $120,000 to buy a Bitcoin, if you were to sell your Bitcoin and use it to pay a bill because the vendor only takes dollars, then the government wants to charge you for saving in a different savings instrument than the dollar, because you have a capital gain on the Bitcoin. Even though you haven't done anything with the Bitcoin, it's not a revenue-producing company, it doesn't gain any interest. And so it just sits there until you choose to pay a bill with it. But because they debase the currency, they want to charge you for the difference in the number of dollars that it now takes to acquire your Bitcoin. Now let's go to the extreme just to make the point. If you have one Bitcoin, and during the year we have 100% inflation because the Fed has flooded the market with additional dollars, then even though it takes $200,000 to acquire the same goods and services that it used to take $100,000 to do, the IRS will forcibly take at least $10,000 for doing nothing other than to have saved your value in something other than their legal tender, leaving you at least 5% poorer in terms of purchasing power. The Algren case highlights the utter corruption of an income tax on an unbacked fiat tender, controlled by and debased by a small elite few, if you only take the time to do the math. Thanks for joining me here on The Effect. Let me know in the comments what you think. And if you've enjoyed the video, make sure to leave a thumbs up, subscribe to the channel, and turn on notifications so you don't miss our next video.